Good afternoon, everyone. Welcome. This is episode 7 of Residential Real Estate Podcast, where we're here to provide accurate, current, and insightful information to our listeners on subjects that will help them make informed real estate decisions and to understand nuances about real estate that you may not have otherwise known about. Thanks for tuning in. This is our 7th episode. We're really happy with how things are going. We're glad you're excited. We're excited to be putting this on. I look forward to this each and every week. We're broadcasting each week on Friday afternoon at 3:30 p.m. Today's July 1st. We're studying the week past for Atlanta real estate. We're going to look at some other charts today. We're going to continue our ongoing series about negotiation. So we're excited to continue to present about that. We're also going to cover 2 other topics. One is the most out of the top 100 overpriced and underpriced markets in Atlanta. We're going to talk about those, what's overpriced, what's underpriced, and talk a little bit about why. And then we're going to go over some things about earnest money. And as we continue to try to bring information about the different parts of a transaction, components of what makes up a real estate transaction as it pertains to residential, we'll continue with that. We'll probably come back to earnest money because there seems to always be new questions and things that our audience wants us to discuss. That certainly could be true about earnest money. I'm going to give an example of earnest money that had a good outcome, but there are plenty of them, outcomes good and bad. So you want to make sure that you do what you can to make sure earnest money is used the way it's intended and delivered in the way it's intended to be delivered, usually hopefully at closing or return to the buyer should things not work out. So anyway, our podcast each week is an hour, about a half hour, and we're going to cover those topics today. We're going to also talk about 2 of our top 25 city lists. We cover those as they get reported quarterly by the National Association of Realtors. We're going to cover Miami and Nashville. We're excited about that. So lots of information coming up. Let's get started. I'm going to start with sharing my screen here on the presentation itself. And so here we go. Let's start this now. I've broken this up to make it a little bit easier to read. And then next week, we're going to be adding some graphs to support how the trend lines are. And then we'll use it as a baseline against last year as well. And any other things you'd like to see in the charts that we're going to create. We hope you'll give us feedback. As always, we can be reached at residentialrealestatepodcast@gmail.com. Our YouTube channel is Residential Real Estate Podcast, and you can find us on Apple iTunes Podcast and any other podcast channel you listen to. But reach us, like I said, at Residential Real Estate Podcast@gmail.com with any suggestions or topics that you'd like to hear or feedback if you have it. So we welcome that. We really appreciate it as well. So going back this week, we're going to highlight just this last column. You can see here it's on our column, it's the week of the 24th to 30th. And on the far right side here, this is the single family home breakdown. So what the goal of this chart, and I think we've stated this before, is to watch the trends as they're happening on a weekly basis. And then as we incorporate these charts, we'll be able to see hopefully trend lines that make sense and can tell a story about what the interest rate and inflation and appreciation rates and how they impact this market and what we're seeing. So anyway, going back to this is our far right column here, and it's you can see that the new listings are up at 1215. You can see our pending sales are down, and then our closed sales are down. I don't think this is really yet an indication of the rate increase that we had a few weeks ago. Today's July 1st. I don't think we're quite yet seeing that change. We will start to see it for sure at any point. But the days on the markets have ticked up a little bit. I think it's easy to fall into the discussion about how that's a real indication of how the market's changed. Let's keep monitoring it before we make any conclusions. The median sales price stayed the same, and it has for pretty much the whole year. But the average sales price ticked down just a little bit. So at 532, 465. That's on single family homes for last week. The average sale list price ratio or percent of list price received is still over 100%, just over 101%, down a little bit, but it's kind of going all around. So we'll see what happens as that continues to go on as we monitor it. We'll keep this chart up on our website when it's going at residentialrealestatepodcast.com, and you'll be able to keep track of these stats and how they're changing and what trends we're seeing. Inventory is slightly up at 6977, and then the month supply is slightly up as well. We want to see that get to a healthier number, so that I think is a good thing for the market in Atlanta. If it's up at closer to 2 months, that's better than down to 1 or less than 1, which we had at the beginning of the year. Here's the same information for townhomes and condos. As you can see, again, it's the same thing, some of the same things. So active listings are up, our new listings are up. That may be attributable to the time of year. You can probably see some of the seasonality, even in our slower markets, the change that you see. And then our pending sales are slightly down. And then we've got around the same closed sales as last week. A lot of that will be that will be the time of the month as well on a weekly basis when you look at it. 16 is the days on the market, and then it looks like the median sales price is up a little bit, and so is the average sales price at $399,688. Our average sale to list price ratio is just over 100, so almost 101, and then we've got 1,697, so just a little bit more homes, townhomes, and condos on the market. And the counties covered here are right here up on the top. And then our month supply is about the same, just under a month and a half for our inventory. We talk about this each week. I don't think it's always worth mentioning, in my opinion. So this is what's covered here: Cherokee, Clayton, Cobb, DeKalb, Douglas, Forsyth, Fulton, Fayette, Gwinnett, Rockdale, and Paulding counties are included in this information. However, when you want that broken down to a zip code or a county or even a radius of an address, I think that a realtor, a real estate professional, we hope that you'll use one, will be able to break that down to your specific interest and what you might be looking to purchase or sale in a transaction. So let's get into the National Association of Realtors market report. These are quarterly reports, and what we have, and we'll cycle through this in just a linear way, because as the second quarter data comes out, we'll go ahead and just cycle right into the city that we're on at that time, so that we eventually will catch up with a full cycle. But this is the information about, we've been comparing the first quarter all the way through today. We'll cover Miami and Nashville. So you can see in Miami, our median home price is well over the national average at 530. And then the appreciation for the 4 quarters ending in 2022, the first quarter of that was 19.1%. So slowing down a little bit. And the conforming loan limit is at just under $650,000 for Miami. You can see our equity accrued to the owner by year and quarter is trending down, but significantly high. So very strong market. The Miami market is, we'll talk a little bit about that when we get to the report from Market Watch that we'll cover here today on some of the most highest and lowest performing markets from an appreciation standpoint. So we'll cover some of those today. These are some of the drivers in Miami of supply and demand. So you can see that the job growth is eased some, but it's still positive, very positive on a year-over-year basis. And then some of the most driving factors of that are, of course, trade, transportation, utilities being at a very high 22%, and then professional and business services as well. But very strong market in Miami. Lots of growth there. These are some of this week that we have in both cases. We have a higher price expectation from the state of Florida than the U.S. average. So this is at 3.9%, and we'll see Nashville here in just a few moments. Let's go over to Nashville. Speaking of, you can see the current median home price is still higher than the U.S. average at $382,700. Our appreciation is up higher than the national average at 22.6%. From the last year through the Q1 of 2022. And the average, the conforming loan limit is at $694,600. Again, here, same that we're seeing really every city we've covered for the first quarter of 2022. You can see the trending appreciation is trending down, but still at a very high number year over year, and then back as far as 3 and 5 years. You can see that that number is going quite up a lot, and so it's very, very positive, and lots of total equity growth since the recession. This here shows the drivers of the local supply and demand for Nashville, still an upward trend for job growth, and so the local economic outlook there is very positive and has continued to be. It's pretty consistent, and again, you can see the state total employment by industry listed there, and Nashville is not greatly different than the U.S. on a national basis. So again, here 4.1% on the price expectations for the state of Tennessee, and this is from all this information is from the National Association of Realtors and the quarterly reports that come out. So now let's shift over to one of our topics today. We've got three topics today we're going to cover, but this is one that I asked some of my broker associates here at the company I work for, Better Homes and Gardens Real Estate Metro Brokers. What is our biggest question, or what comes into question the most when it comes to broker support in general? And we are the largest brokerage in the state of Georgia. This is really relevant. A lot of people want to know, and I get this question from buyers that with lots of experience purchasing and selling, as well as buyers that are brand new. So I hope this is a great overview. If you have specific questions, ask your real estate professional. Write us at residentialrealestatepodcast@gmail.com. We're certainly happy to direct you with earnest money questions the best we can, or direct you back with better questions to ask the broker that you're being represented by. In any case, let's go into earnest money. Let's talk a little bit about it. This is a general overview. So let's start out with why earnest money. And so, some of the biggest things that earnest money does is it allows the seller to feel comfortable that a buyer is serious enough to take the home off the market. So the seller takes the home off the market. They know that the buyers put money up at risk with the understanding of what has been negotiated, whether it's due diligence or financing, maybe an appraisal or some other kind of contingency. And when I say that, there can be any number of specific contingencies for different things that could come up, but definitely when you have a contingency, that's why you do the earnest money. But you get the earnest money basically to take the home off the market as a buyer with the seller, and so it's the money that you get back at closing as a buyer, but it's the money you lose if you don't follow through on the contract. So this safeguards the interests of the buyer and the seller. So it helps both parties maintain an agreement in place, and the buyer wants, and this came up with the client this week, the buyer wants to know that the seller is taking earnest money so that in good faith, they can go through the trouble and expense of getting an appraisal ordered, getting an inspection ordered and done and completed, and through negotiation, and going through the application fees that they may have for a lender or any other costs associated with the purchase, so that if they put earnest money forward, then they know that they're taking the home, and they can buy the home as long as they follow what's been agreed to in the purchase and sale agreement and any other parts that go along with the contract. The seller, again, it's the same thing. They maintain the agreement in place to protect the buyer against unnecessary expenditures that would otherwise be wasted should they not have an agreement in place. And then, but they can still accept backup agreements. So you can tell your seller clients, of course, if you're a realtor, hey, take this backup contract. You can take earnest money from them that'll be effective should the first buyer terminate. Whether you give the earnest money to the buyer or not, you can go ahead and pursue backup agreements if that comes about, or that's a possibility. And in this market that we're in now, that certainly has been more often the case with backup agreements than in my almost 25 years of experience than I've ever seen. So anyway, that's why How much? That's the next question people ask. And so when it comes to how much earnest money, a good rule of thumb is 1 to 3%. I can remember in around 2000 and even before and after, I was writing contracts, and some buyers would put down $1,000 or $500 earnest money. A good rule of thumb is 1 to 3%, 1 to 2%, 1 to 3%. But it needs to be enough to be a significant financial change for a buyer and or seller should the contract not work out. So the idea is to keep people in a position to want to maintain the provisions of the contract and follow the timelines and go through with what's been agreed by both parties. So competitive bids. So when you ask how much, I see a lot of buyers will make higher amounts of earnest money, put higher amounts of earnest money at stake to be a more attractive offer. So if there's two offers that come in on a $500,000 or let's say $1 million home for sale, and one comes in at 10,000 earnest money or 1%, and one comes in at $50,000 in earnest money, and it's 5%. So that's over the 1 to 3% rule of thumb, but certainly significant, and it shows good faith in a way that is marginally more attractive than a smaller amount of earnest money of 10,000 at the $50,000 earnest money rate. And so in risky transactions, the buyer may want to put or require less. If there's a reason to think that the earnest money would be risky in some way, you may want to put less. It may not be a significant factor for the seller, in which case, less is always better if there's less at risk. So anyway, those are all things to consider. Who gets it? When I would say that, like, who do you get to hold it is a better question, probably. So that's totally negotiable. The seller can make a demand to hold the earnest money, or the seller can make a demand for a specific person or party or company or attorney to hold the earnest money, but it is totally negotiable. Now, in a market like we're in right now, you may not want or to negotiate or try to negotiate who holds the earnest money. If the seller directs it, it's likely that the buyer that makes the seller happy with who they choose to hold the earnest money might be the one that the buyer bid that makes the winning bid. But the seller can hold it. That's usually only happens when it's not refundable. The buyer's broker or the seller's broker can hold the earnest money. An escrow agent or a closing attorney can hold it. And so just the pros and cons. I've always said it's best to have the broker for the buyer, if I'm representing the buyer, or the broker for the seller, if I'm representing the seller, to hold the earnest money, because that's the quickest way. If your client has the earnest money with your broker, that's the quickest way to make a reasonable interpretation of the contract. It doesn't give you the authority or leverage to make an unreasonable interpretation of the contract, but what I've seen in experience and what I've heard from broker support feedback and other brokers that are in the industry is that when you have the earnest money in a trust account and you can make a decision to disperse that earnest money as you see as a reasonable interpretation of the contract, that can be the easiest way to keep from mediation or arbitration or litigation. So that's a good strategy, a good practice for going with your client's best interests in mind wherever possible. I had an example of this, unfortunately, in 2021, where I had a corporate client that was relocating to Atlanta, and thankfully the provisions of the contract were very carefully followed, because the appraisal came in significantly less than the agreed upon sales price. And so 13% less than the agreed upon sales price. Well, the buyer was putting 20% down, and the lender had agreed to loan the money at an 80% loan of the total appraised value. Well, when that happened, of course, the buyer was not willing to pay the additional 13% over the appraised amount to make up the difference. So fortunately, and I would definitely get your broker's direction on this, because it makes it far easier when your broker is involved and there's paperwork that follows the guidelines they've given you to disperse that earnest money correctly and it's handled correctly. Notices are appropriately done, and so making sure that those are definitely, those guidelines are followed will be a smoother path to the appropriate party getting the earnest money in a disagreement or dispute over it. So anyway, we talked a little bit about these, but the seller can hold it. That's a riskier proposition. It's harder to get money back sometimes when you have the seller interpreting your buyer clients reasonable process through going through the contract. The buyer or the seller's broker can. So that can be a really good strategy when it's your client. You want to ask that you hold the earnest money as representing your client. And then the closing attorney or the escrow agent can hold it. And I just want to reiterate one more time, a lot of times these parties, even though they're great people to hold the earnest money because they are neutral and they are far less likely to interpret the contract and disperse it when there's a dispute. So they'll pass off that interpretation to an arbitrator or mediator or even the court. So that's those are some of the outcomes and pros and cons that go along with each of those. Next here, when do I get it back? When do I get my earnest money? So I'll get it at close. That's exciting. So hopefully we'll go through a transaction in a successful way, and you'll get your earnest money as a credit at closing. If you're putting 20% down, and say you put down 3% earnest money, then you'll need to make up the difference in the down payment portion of your down payment at closing in a wire form here in Georgia. And you'll do that at closing. You'll get that credit at closing off to the sales price as part of your down payment. And then the other way you get it back is if and during your contingencies, if there's a valid reason, here are some of the possibilities that could be, like your financing contingency. Say you don't get the financing that you thought you could get, and you're within your financing contingency time period, you can get your earnest money back that way. If the appraisal comes in low, there can be some specifics around this, but if your appraisal comes in too low and the buyer and seller can't agree to an appraised value as provided in the contract, it can be dispersed back to the buyer if that's what's written into the contract. If there's a contingency for permits that need to be done, or rezoning, or some type of variance related to zoning, or due diligence. In Georgia, we have a due diligence period that's provided in our standard Georgia Association of Realtors form. That form has a due diligence period. And over the years that provision has been in the contract, it's become just a due diligence period where for whatever period that's agreed upon, you can change your mind for any reason, most likely related to an inspection. But that's a due diligence period where you have the right to get your earnest money back, really without a reason. So that can be what happens if it's during that timeline. So how do you lose your earnest money? No one wants that, but how do you lose it? Here's some of the ways. If you don't have a contingency and you change your mind, if you fail to follow the language and the provisions in the contract, if you don't meet your timeline, so a lot of times you can miss deadlines that are relevant to earnest money. You find yourself in breach, or your cooperating party in breach. That can be a reason to lose earnest money. And then changing your mind. This unfortunately has happened, and people change their mind. People change their plans, and that can be a way to subject your earnest money to being lost in a transaction where you have an agreement that doesn't allow for that. So the thing that you want to keep in mind is protecting your earnest money. Just understand the contingency, know your timelines, use your broker's escrow account, and then make sure that everything, even changes or agreements that you make on the front porch with the seller at an inspection or elsewhere, make sure those are in writing. And exhibits to the contract, or amendments or addendums to the contract, not just a quick note, or make sure that all parties are notified of that. And then the other ways that you can lose your money is the lack of contingencies, not following the contract, not meeting your timelines, and again changing your mind after due diligence. Let's shift over into another part of our series about negotiations. These are going to be slowly unrolled, unveiled to this series. And today we're going to just talk about, last week we talked about knowing what you're negotiating and we used the example of negotiating with the brown paper bag and an object inside the bag that neither negotiating party knew about, and how it's best to know what you're negotiating for. So what's the current market conditions? Why are they selling? All of the things that you can know about, those are helpful to negotiation. All the details about a property. So knowing what you're negotiating, what it is and the value to the parties and what can be agreed upon. A lot of that is based on what the seller knows what they have, the buyer knows what they want and what they're getting. That can be most useful to both parties. But definitely know what you're negotiating for. Today, we're going to continue that, covering what a plan of action would be. We're going to talk just about a few things. This is a little bit briefer topic today. But the main thing about today is when you set out to start a negotiation, having a plan of action. And so there's several things to cover here, but mostly expectations. I like to think about like a best, worst, and likely case scenario. So 3 things there. The subject party's goals and roles, and then the negotiators' goals and roles. So I say that to say, what are you trying to get for your client? What's really important to them? Is it a certain time frame, a certain price, a certain closing date, certain things about maybe a school district or a neighborhood, proximity to family or some other work, something like that. So knowing what their goals are, and then how do they fit into the negotiation and that sort of thing. And then the limitations of the negotiation. So what things that are not negotiable, and just knowing what those are. I think that's a really relevant point, is just that some things may not be as negotiable as others. Other things to know are, what is your competition? Like who else is negotiating with the other party? If it's a seller and you're a buyer, are there other buyers? If there's a buyer that's looking at your home, are they looking at others? So just know what the competition is. What timelines there are to consider. So when maybe your leverage changes at some point. So having a game plan around different timelines, if there are some, and what that might mean. If you, as a good example, if you have someone that's trying to transfer to a job and they need to negotiate something that would allow them to move into a home by a certain time, or a school district, or other timelines that you need to think about. And then as you go through monitoring the goals and roles, that may change as you start to negotiate. There may be new goals. If something may change with your client or your situation, where you can better help, or maybe some things change that would affect the negotiation. Just kind of keeping an eye on those. And then always after the fact, if things don't work out, or even if they do, maybe for yourself, do it after action review. If things don't work out, what could you have done? I had a client that we negotiated for this month, actually June, and we likely could have won. We didn't we purposely decided not to put in an escalation clause. I feel if we had, we might have had a very good chance of winning the contract, which is neither good or bad. It's just what happened. And, should we have put in an escalation clause? Is that something we would do next time or not? Or would it depend based on the property that we were negotiating on? So think about after action reviews, and then what you might have done differently had you really wanted it, or did you do exactly what you thought you should have done, and you just are where you are. So that's a good way to think about negotiations after the fact. So next, let's talk about one more thing today, the 100 housing markets in America. There's a report that just came out from Market Watch, where 2 professors, one Ken H. Johnson and then Eli Baracha, 2 professors in Florida universities, one at Florida International and the other at Florida Atlantic. And they developed a method to measure the Zillow Home Value Index. And it's a long-term trend for home prices, and then estimated the market average expected price and compared it between those two. And so they studied the premium between those two numbers. And so let's go to this slide first. And these are the least overpriced markets. They're listed here by the lower amounts. You can see those as they go up. These are some of the least overpriced markets. Baltimore, Honolulu, New York is surprisingly on there, Washington, D.C., Hartford, Connecticut. And then these are some of the most overpriced, Atlanta being one of them at almost 56%. But you can see Austin, which we have heard so many things about and how incredible that market is with demand. So at almost 67%, 66.29. And then three cities in Utah. So Ogden, and then Provo and Salt Lake City. And then even Charlotte, very, very Vegas is roaring back at a high rate there. But going back to this, let's talk about why they think it's happening. They think it might be partly related to the downturn that happened in 2008. Another factor they thought was maybe people are interested because of COVID or other factors. Maybe they're working from home now, so they don't need to be in a densely populated area with maybe less commute time or whatever that case is, or whatever that motivating factor is. So they can move into areas that are a little bit more affordable and maybe a little bit more home for them. If that's what's going on. Maybe when they take that wage amount and move it into that, it feels like a wage increase. I mean, some people are getting more pay, so wage increases they thought. And so I said a little bit alluded to this, the demand where it's more affordable. There's also, they thought, demand increasing for second homes. That happens a lot of times. It takes time to catch up after a significant downturn like we've had in the last 10 years, where second homes, people get their incomes back in line. And especially when we had COVID, I've read many places that people stayed home and saved money and paid off debt. So they maybe were in a better position over the last couple of years to pay down that debt and own a second home. And then they thought supply and demand just more generally, just like supply and demand have gone up in general. Supply's gone down, demand has gone up. That's driving those aggressive numbers. And then other studies have been done. CoreLogic also studied this, and they found that there are other markets, 4 cities in Florida they cited, Destin, Naples, Punta Gorda, and Homosassa Springs. And then Austin still is on that list as well. So that's some of the details that came out of the report. Very good report. Upcoming topics. So for episode 8 and beyond, and by the way, thanks again for joining today. We so enjoy providing this information on a weekly basis. We so enjoy having you as our listening audience. We really value your feedback. Please email us at Residential Real Estate Podcast. It really helps us. We want to give you the information you want. So please send us a note. Tell us what you want to hear about. So we talked about, we're going to keep monitoring interest rates and what's going on with that. Why interest rates as they increase, what that effect is. We said before, we'll just reiterate, we think the rates change that we've had over the last week to 10 days has really, it's going to have longer reaching on a horizon period outcomes. And so we're by monitoring this on a weekly basis and quarterly basis and even monthly basis, we'll provide those charts as we're just getting started. So our charts are going to get better and better with data that we're tracking since we started the podcast, Residential Real Estate Podcast. So this will be, more ongoing is the best way of saying it. Next, we're going to talk about due diligence and what can be done in due diligence, what I advise clients to do in due diligence. We talked about some of those things over the course of the first 7 episodes, including today. We talked about earnest money a little bit. So we're going to always be monitoring this, but should I buy, should I stay put, or should I sell? We're going to talk about that and still keep an eye on. That's a hot topic for news and journals, so we'll keep an eye on that. Coming up, we're going to invite some guests to talk about things related to floods, whether it's a condo, building, or a house. We're going to talk about roof damage, and then generally we're going to talk about warranty coverage. We're going to invite guests on to talk about these things and what might be expected We've got our guest coming up, I believe in July for a credit repair. We're going to talk about that. He owns a credit repair business. We'll be excited to hear from him. And then we're going to keep going with our negotiations and tactics for buyers and sellers on the negotiations topics. And then more statistics and guests we'll have coming up. And again, I haven't said it once, I will say it again. We welcome your suggestions. So if there's a topic you'd like to hear about or discuss, please let us know. Residential Real Estate Podcast at gmail.com. Thank you so much. Have a wonderful 4th holiday, and we hope you'll tune in again next week. Thanks so much.